Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast. I already know this is going to be one of our most popular episodes of the year. Why? Because we're bringing you economic concepts that just aren't covered elsewhere. And for those who are turned off by economics, don't be. When you understand what is going on in the world, it unlocks the ability to create wealth. And that's what we're going to do for you in this episode.
Welcome to the Property Podcast. Thank you for joining us. If you don't know, we run a business that buys more than £100 million worth of property per year for us and our clients. You can find out more about that at propertyhub.net/invest. But today we are asking, will property continue to be a solid investment in a new economic era that we're moving into? Stick around to find out.
So it's time for our news story of the week and some cheery news from Keir Starmer. Cheery if you like paying more tax and seeing services cut, because Keir Starmer has said the autumn budget will be painful. There's no dressing that one up. Doesn't sound like fun at all. I think he's trying to get us ready for a budget that is not going to be a popular one. But they are saying, they being Labour government, that it is needed. What's really interesting to me when you look at this is if you increase taxes and you cut back services, and it doesn't matter what those services are, but if you cut back spending and you increase taxes, that's austerity. And austerity measures was something that Labour heavily criticised when the Conservatives got into power. And just like now, Labour are blaming the last government, back then, Conservatives blamed Labour. Now, who is to blame? That's not for me to say. Is this the right thing to do? Well, these are smart, clever people, and I'd like to think they know more than I do. But I think it's clear to see that austerity measures didn't do anyone any favours last time around. So it's really surprising to see Labour heading in that direction. Now, they haven't done it yet, and we will wait and see. What's positive is the economy as a whole seems to be doing quite well. So let's hope that the changes aren't too drastic in the autumn budget and it doesn't derail a recovering economy. Of course, we will keep you updated and we'll really deep dive into this as and when the news is released. And of course, when the autumn statement happens, we will give you our reaction then. People will often say, oh, everything's changed, the world's changed, things are moving so fast. And you know what? They're right. But that's always been a constant. Change has been a constant. But the economic world that we now operate is very, very different than it was 10 years ago, even 5 years ago. And with change, you need to adapt as a property investor. And most importantly, not just adapt, but understanding what you're adapting to. So today, we're going to get a little geeky. We're going to get into economics. We know a lot of you love these type of episodes, but we're going to try and make it as accessible as possible because we want you to understand the new financial era that we're living in and how you, as an investor, can thrive. So, Rob, it's easy to say we're in a new era, but what makes it new?
Well, I wrote a whole book about this. I'll see if I can compress this down to a minute or two. Because for me, there are four main characteristics. So the first is higher interest rates. Obviously, interest rates were pretty much nothing. Now they're not. They might come down a bit, but they're not going to go back to where they were. So that's easy. We're certainly going to have higher interest rates than we have done for the last 15 years or so. We're also likely to have higher and more volatile inflation. Again, clearly, we've had high inflation recently. As of right now, that seems to have come back under control. But there's lots of evidence that shows that for various reasons, once you've had an inflationary spike, getting it completely back under control is really hard. It takes time. You think you've done it, and then it just spikes back up again. So we're moving from an era where inflation just hasn't been thought about to an era where it's going to be far more of a factor. A third feature is high debt levels. So remember last time we had a change in government, they were talking about getting rid of the deficit, paying down the debt. That's not even being talked about anymore because it's so clearly not going to happen. Public debt, especially after COVID, has hit a massive high, but businesses, consumers, everyone has huge debt loads. And that is really important, especially considering that interest rates are going to be higher. And that very much ties into the fourth characteristic, which is that even though interest rates are going to be higher than we've become used to, real interest rates are likely to be negative for a lot of the time. So, Rob, I think those first three are pretty easy to understand, pretty uncontroversial, but it's probably worth explaining this concept of real interest rates.
So when the word real is used when it comes to asset prices or anything, it's when it includes inflation. So real interest rates are the interest rate that we have. So today we have an interest rate of 5%. And until recently, inflation has been higher than that. So what you would do is you would take interest rate minus the inflation rate, and that is the real interest rate. Now, at the moment, this isn't in play. We have interest rates that are higher than inflation because inflation has fallen. But Rob has mentioned that we have higher and more volatile inflation. While it's it for now, most economic commentators are suggesting, and we're agreeing, that it's going to be more volatile moving forward. For years, it would hover around the Bank of England target of 2%. It might go 1% either way, but that's generally where inflation landed. What we're suggesting, and many others are suggesting will exist moving forward, is that, yes, today it's close to target, but in a few months' time it could be above 4% again. The world is more interconnected than it's ever been before. We've talked about if QE is reintroduced in a major way by America, ourselves, or other countries, then that can impact it. Wars can impact it. So while it's settled recently, it's only been very recent that it's settled, and it's more likely than not that it will be unsettled for the foreseeable future. So that could be a few years or it could be a bit longer, but it's certainly more volatile now than it has been for decades. And I think, Rob, this is really interesting, all of these points here, because while a lot of people may have not operated in these environments as investors, these environments have all existed before. So it may be new territory for somebody listening, but it's not new territory when we look back at history, because we have been through all of these things before. We have been through high interest rate environments, in fact, much higher than we have today. We've been through volatile inflation. We look at the 70s in particular. Increased debt levels after the Second World War. We've had massive debt compared to the GDP. We have massive debt again. You have negative interest rates. This again has played out before. So it's all new if you look in recent decades, but it all has played out before when we look at history. And that helps us.
It does, because if we're in for a set of financial conditions that we haven't seen for quite a long time, then it's likely that what's been working recently may not continue working again, because the reason people do the things that they do now is because they've seen them working well over the last 20 years. But if the world has changed, then we need to go back and reevaluate how different assets perform under different circumstances and which assets are likely to perform best in this new era that we're going into.
So it's important to understand the world that we now live in, and hopefully we've got that across to you. But if this is the new world, what are the ideal investments, or what's the ideal asset for us to be investing in? What characteristics should these assets have? Because if you want to thrive in this environment, you need to buy assets that have certain characteristics. So let's go through that list, Rob. What are we looking for when we invest in property and beyond? Like, it could be property, but let's just look at all asset classes. What are we looking for? What are the key things that will not just allow us to do okay, but actually excel?
Okay, well, I've come up with 5, and we can maybe debate this list or add to the list, but I think there are 5 core things. So the first is you want something that you can buy, ideally, with debt. Because if real interest rates are going to be negative, which granted they are not today, but highly likely that they will be again in the future for reasons we've discussed, if you can buy assets with debt, then you end up winning. You also want an asset that's going to hold its value in the face of inflation. Because again, if inflation is going to be higher and more volatile than it has been in the past, you don't want to get punished by that inflation. You want to ideally benefit from it, and at the very least, have an asset that keeps up with it. You also want an asset that has supply constraints. You can't just magic up a whole load more of it out of nowhere, because that very much ties into the inflation point. That is what causes something to hold its value. So you want limitations around supply. You also ideally want something that has real utility, that has some kind of value in the real world. Because if we're in for times that are more troubled than we've lived through, which is not very nice, but entirely possible, you don't want to hold nice to haves. You want to hold things that people actually want and need all the time. And finally, we've talked about the asset holding its value in the face of inflation. You also want the income stream from that asset, if it has one, to hold its value in the face of inflation as well. Otherwise, you could start off with something that seems like a really great return, but then it just gets gradually eroded over time.
I think most of these are pretty obvious. So holding its value in the face of inflation, we have inflation. So if your asset diminishes in value, then it's not a good thing. The one that may not be as obvious is purchase with debt. And the reason why that's so important is because your debt will be devalued by that inflation. So we're going to move into different asset classes that you can assess with these characteristics in play. But if I take cash as an example, it's debatable whether you call cash an asset. But if you say, okay, can it be purchased with debt? Well, yes, you can actually get more cash with debt. So I suppose that's true. 2, does it hold its value in the face of inflation? No, it's actually the cash that is not holding its value. More of it is created. And that leads on to the third point, which is, has supply constraints? No. QE keeps creating more and more of this cash. Governments keep turning on the virtual printing press. So it doesn't have supply constraints. In fact, it has the opposite. It just more and more is created. Possesses real utility? Yeah, it does, because you use it day to day, and provides an inflation-linked income stream. Cash itself doesn't. You can put it into things that does, but cash itself doesn't. So hopefully when I give you an example there, you can see why all 5 are so important. Cash maybe ticks 2 of those 5 boxes, but because some of them go against it so much, it's a terrible long-term asset. So let's look at asset classes that we may consider in this environment. Let's start with the stock market, Rob, because that is probably the one that most people, maybe not on this podcast, but generally the most people will invest in, because that's what people are taught to do with their pension. They may not invest directly, they may have someone investing for them, or they may have a fund that does it. But the stock market, most people are familiar with that as an asset class. So how does the stock market stack up when we assess it against these 5 things that we've listed out here today?
Well, not too badly on a few of them, but there are a couple of areas where it falls short. And by the way, the outcome of this episode should not be sell this, get out of this. It's all a disaster. No, not the case. Ultimately, most people will be wanting to hold various asset classes that all do well at slightly different times in slightly different ways. So this is not an, oh my God, guys, you've got to get out of this. So I think it's just important to frame that before I talk about the drawbacks of the stock market, because there are a couple. One is that stock markets generally don't respond well to high inflation. They can cope with moderate inflation, but high inflation and inflationary spikes are problematic. And that's for a few reasons. It's because it increases uncertainty around interest rates, which causes problems in terms of their cost of funding and debt levels. And it's because they start having higher costs, and different companies have different abilities to pass on those higher costs to their consumers. So high inflation can be a problem for the stock market in general. But I think the biggest drawback, Rob, is a point around buying with debt. Now, obviously, buying anything with debt is kind of an advanced move. It's a mindset that many listeners of this podcast will understand. But in the general population, most people are, oh no, debt bad, you want to get rid of it completely. We've talked about why it can be beneficial to buy assets sensibly with a level of debt. But investing in the stock market using debt, I would put down as a super duper ultra advanced move that most people would probably not want to do, because it's a relatively volatile asset class. There is an unacceptably high probability that your asset is going to dip in value, even if that's only temporary, and you're going to be asked to put in more and more cash against your loan to effectively bring its loan to value back into the right range. And if you can't do that, you end up getting liquidated and your stocks get sold at exactly the point when the market is lower, which is not something you want to happen. So for me, Rob, I'm not saying the stock market is going to have a disastrous time of it, but I am saying that for most people, you're going to miss out on the benefit of leverage when it comes to the stock market.
Yeah, for the vast majority, it should be like 1% of stock market investors, possibly less, should be doing this. Rob and I are fairly well versed in the stock market. I'm not saying we're experts, but probably follow it more than the average person. We do not use leverage, the stock market. Even though we understand the power of leverage, it's so risky in the stock market. It's just, for us, not worthwhile. And for the majority of you listening, you only have to look over the last month of what the stock market's done. Now, I'm not bashing the stock market. As I said, we both invest in stocks as well. And over the long term, you can do some great things. And actually, when you look at the list that we've given and the type of things you want from an asset, the stock market holds up pretty well, except this key point of being able to use debt. And while technically you can, you probably shouldn't. So overall, the stock market performs pretty well against our assessment, but it's not perfect. There is no perfect asset, but I think we can do better. Let's look at another popular asset class. A classic. The classic's maybe a classic for a reason, and it's gold. So gold has sort of a supply cap. It's not a hard one because you can find a new mine and a miner may decide to really ramp up production and extract everything out of that mine, but it's unlikely because that doesn't serve their interests. So historically, you tend to see an increase of up to around 2% annually, 1.5% to 2%. So a soft supply cap. Now, one of the reasons that Warren Buffett famously isn't a fan of gold is because it has no income stream. So you buy the gold, but it just sits there, whether virtually or physically, because you can buy the physical version if you wish, but it doesn't give you anything in return. It's a pure asset, but with no income stream. So for that, it gets marked down. Where it gets bonus points, though, is that historically, it maintains its purchasing power over long term, which basically means it keeps up with inflation over the long term. Gold is seen as a hedge by many against inflation or volatile periods. So you look at gold historically, when the world is a bit more volatile, whether it be financially or major wars, then gold tends to perform quite well. When there's an uncertain market, money moves to gold because it's been around for so long and people feel safe by investing in an asset class that has so much history. So gold does very well, and it has technically real utility. The gold bars that you're buying, you're not going to turn them into watches or necklaces or bracelets, but they could be. So gold does have some use. So it's not perfect. You're not going to buy it with leverage. Again, possible, but you probably shouldn't. And it doesn't provide you an income stream, but it does certainly tick some of the boxes. So it's a good asset class. Probably not performing as well as the stock market. If you're trying to be clever, you could try and buy a stock that is linked to gold and get some dividends from that stock. I know Warren Buffett has used that as a tactic in the past. So that's a way of getting some gold exposure with an income stream, but still it falls down on the leverage point.
Okay, let's move on to another asset class, probably actually the biggest out of all of these, even though it's something people tend not to think about that much, which is bonds. So lumping together here, government bonds, corporate bonds, that works. Any form of lending to some kind of entity and receiving an income in return and then getting your money back at the end. Now, I've written in the past about how I didn't get bonds at all. I thought the whole investment case for bonds made no sense. But that was at a time when the bond market had just been through like a multi-decade rally. They were incredibly high priced and the yields were almost non-existent, which would mean even the tiniest bit of inflation would result in you coming out with less than you went in with. But in 2022, there was a massive bond crash. Bonds had their worst year ever. And that actually has significantly improved the investment case for bonds because now, as a result of their price coming down, the yield is higher, so you're more likely to end up making a positive return. But there are still a couple of problems with bonds for the era that we're moving into. One is that they have a fixed income. They're a fixed income investment. It's in the name, which means you might put £100 into bonds. You get paid a £5 income stream. That's great. 5%, not too bad. But you don't get 5% every year. You get £5 every year. And so obviously as inflation goes along, £5 is able to buy you less and less and less. So in an inflationary environment, that is not so helpful. The other way in which bonds fall down in terms of the characteristics we laid out is that there is no supply cap, especially in the case of government bonds. We've seen this before. An event happens, suddenly a load of extra money is needed, and poof, hundreds of millions of pounds of extra bonds have been issued. So there was a point in the past when I would have said, bonds, they just make no sense. I don't get it. I'm definitely not at that point now, but I'm not super enthusiastic about bonds for a large proportion of my investments for those two reasons.
So we talked about gold. What about digital gold? Bitcoin? I think it's debatable that it should be called digital gold. There are some similarities, which we'll get into, but actually, if you look at how Bitcoin performs versus gold, they are very different. And let's start with the elephant in the room when it comes to Bitcoin, the volatility. It is super volatile. It can go up 30% in the space of a few months, weeks, or even days, and it can do the opposite. It can go down by that amount. It's very volatile, whereas gold is a lot more steady. But where it's similar is, and this is possibly why it gets called digital gold, is it has a supply cap. So gold doesn't have a hard one, but Bitcoin absolutely does have a hard supply cap. There is only so much Bitcoin that could be produced. So that's where a lot of the comparisons are made. Just like with gold, there's no income stream either, which, as we've talked about, gets gold marked down. There will be some people listening that say, well, actually, you can get a return on your Bitcoin, but Bitcoin by itself, you can't get a return. Like with gold, you can do some clever things to try and get a return, but by itself, it doesn't give you a return. Does it have utility? Well, some people may argue that it does. I would argue that it doesn't. It doesn't really matter. I think the point is it's debatable. I don't think there's a hard yes. Whereas some of these other asset classes, there is a hard yes. It has utility. Again, Bitcoin can be leveraged, but by most people, it should not be leveraged, particularly how volatile it can be. Like we talked about the stock market being a bit volatile, but the stock market will get headlines if it moves by 5% in a week. That's massive news. Bitcoin can do that in an hour. Like, it's crazy, like the volatility. So leveraging against Bitcoin is for the very brave, possibly the very stupid. Leveraging is technically possible, but should you do it? Oof, I certainly wouldn't. Out of all the things we're talking about today, that is the last one I'd be leveraging against. So Bitcoin, again, can tick some of the boxes. I'd probably say out of all the ones we've covered so far, probably the least, but it does perform well in some of the categories. So Rob, it's been a bit of a mixed bag. I'm sure everyone expects us to land on the next asset class eventually because we are the property podcast. But how does property stack up?
Well, I'm sure some listeners will have been playing along in their heads and trying to think in advance about how property stacks up against the tests that we set up at the start. And maybe it's not a surprise for the property podcast. Property holds up very well. It's not perfect. Of course it's not. And we'll come to that. And as I said at the very beginning, most people will want to be diversified across a range of asset classes. So it's not a case of, sell all those other ones and buy property. But property does fare well across all these measures. So first, you've got the income stream. The income stream generally is linked to inflation. It's not the case that you buy a property, it makes £500 a month in rent, and that's the only £500 that you'll ever have. No, over time, rents go up, driven by wages, driven by inflation. So all good there. It also has a long track record of its value keeping pace with inflation in the long run. Obviously, we've talked in the past about how property is cyclical. So if you buy in at a high point, you can expect to underperform for a while. And the opposite if you buy in during a dip. But over the long term, property has kept pace with inflation, in fact, outpaced inflation over a very long period of time. Obviously, it has real utility. Obviously, it has supply constraints. You can throw a lot at trying to build more of it, which is happening at the moment. But you can't meaningfully increase the overall stock in a short period of time. And of course, the big one, you can buy it with debt. In fact, there's an article that I'm sure we've spoken about before. I've definitely written about it in the Property Pulse newsletter by Lynn Alden, who's an economic commentator who I'm a massive fan of, who's basically said the reason the property works as an investment is nothing to do with the property, but it's purely because it's the perfect asset for securing large amounts of debt against. And I think there's a strong argument for that view. Because property doesn't have visible volatility. If the price that you can sell it for does change day to day, you don't know about it, which reduces the risk of attaching debt to it. Of course, that means that you benefit from inflation because the debt that you have becomes proportionately smaller over time due to inflation. And of course, you benefit from inflation because the debt becomes proportionally smaller as a proportion of the overall value as a result of that inflation. There is, of course, risk around interest rates. We talked about how nominal interest rates, at least, are going to be higher than they have been over the past couple of decades. But the good news from a property point of view is that that has already happened. That risk was more there when rates were zero, and they clearly weren't going to stay zero forever. Now you've got rates at 5%. Are they going to go up a bit? Maybe. Are they going to go up to 10%? Very unlikely. So if you're buying property now, then because the adjustment has already happened, that risk has been reduced. So Rob, property unsurprisingly is looking pretty good. But as I said, we do need to acknowledge that no asset class is perfect and property is no exception.
Yes, even though we are the property podcast, we are going to find flaws with property because there is no perfect investment. So what are the drawbacks? Some of them will be obvious, some less so. So let's go through them. Well, first of all, political risk. You can't easily relocate or quickly liquidate your property. So let's take Bitcoin. If you needed to move out of this country quickly, you could take your Bitcoin with you because it's not fixed anywhere. And if you needed to sell it quickly, then you probably can as well. You can't do that with property. Now, we know one of the reasons why internationally so many people invest in the UK is because it's so stable, but politically and to a degree economically. So people do feel safe investing in this country, but it still exists. And if you look at property worldwide, if you invested in different countries, for example, and I know some of you listening do, then this is one that you really need to have your senses sharpened to because political risk does exist, certainly more so in some other countries. So political risk is one. And it's not just, is the government suddenly going to go crazy and try and lock everyone up? It could be a lighter version of that where the taxation rules change and suddenly as an asset class, property investment may not work. Because you can't take your asset with you, you would be trapped. Again, highly unlikely because some of the wealthiest, most powerful people in the country are property investors, but it's worth highlighting. The other big risk, and I kind of touched on it already with the selling quickly part, is the illiquidity. You cannot sell a property in a day. You can sell every other asset class we referred to today, if not instantly, very, very quickly. You cannot do that with property. So that is a downside. You could argue it's also an upside as well, because that's why it's so easy to get leverage. The lenders are happier for that reason. It also protects the asset against you, the human, being impulsive. So suddenly hearing a piece of news and go, right, I'm going to sell it. You can do that quite quickly with all the other asset classes that we talked about. But even if you have a rash day yourself, or your significant other has a rash day and asks you to sell it, well, you can't. It can't be done that way. So the illiquidity, I suppose, can have upsides, but it can be seen as a negative as well. And I think, Rob, because of that, more so because of the liquidity issues rather than a political risk, I think that's why property investors may have property, but will also look at other asset classes like we do as well. Now, without question, because of the leverage point, property makes up the majority of our respective wealth. But we do invest in other asset classes because sometimes it's good to have cash available to you, but you don't want cash sitting in a bank because we've already talked about how awful cash is as an asset. So you're going to put it into one of those others, whether it be the stock market, bonds, gold, Bitcoin. Most property investors are going to invest in those as well. But overall, if you're looking at a long-term asset, it is hard to argue against property. And I know we're biased, and you probably listening are biased as well because you've chosen to listen to a property podcast. But what we've talked about isn't really an opinion. It's just the facts of life now. It's like where we are at, what the world looks like economically, and how different asset classes behave. And luckily for us and you listening, property performs very well.
Yeah, exactly. I mean, of course, there's going to be some confirmation bias in here. There has to be. But I think, as you hinted at, Rob, it's hard to argue with most of the facts. I think any points of disagreement would be about how you'd weigh up different factors and different risks. So, for example, one person might be extremely concerned about political risk, and that would outweigh everything else put together. But I think really that's where disagreements would come from. But I don't expect we're going to get that much pushback because we're saying to an audience of people who are interested in property, yeah, property's a good thing to do, and arguably set up to perform better than ever. And I find it really helpful to go through this exercise and think it through in the way that we have, because there is so much negativity and uncertainty around, as I suppose there always is, but there particularly seems to be at the moment. So I think it's helpful to actually go back to basics and remind yourself of why property works so well. And as you said, not just property, most people want to invest in other things as well. I personally have positions in every asset that we've spoken about, but I'm particularly committed to property. And that's why when there is so much noise, so much uncertainty, and it's so hard to keep the faith in the short term, reminding yourself of these underpinnings that are always there, but where they seem to be aligning even better with where the world seems to be moving, I find that reassuring.
And that's why I'm really excited about next week's episode and you getting to listen to it, because it builds on this episode and last week's episode about how the property market has been performing recently, because it's really going to surprise you. The data that we get into next week took Rob and I both by surprise. So it's going to be really interesting. If you've not listened to last week's episode, make sure you do. This builds on that, and next week builds on the two. So they all go together so nicely. So make sure you complete the trilogy and join us next week. It's time for Hub Extra. Before you part ways, let's just ram a bit more value down your earbuds or speakers, however you're listening, and let us give you a resource and a bit extra, Hub Extra. And remember, this is all backed up by Property Pulse, our amazing newsletter that is completely free, that lands in tens of thousands of people's inbox every Friday morning. If you are listening to this podcast and you have yet to sign up to it, then you are bonkers. It's like you've leveraged against no education. So make sure you're leveraging the right way and get yourself signed up to Property Pulse. Super simple to do. It'll take you seconds and it's a great investment of time. It's propertyhub.net/pulse. Which links me nicely in to this week's Hub Extra because it's about email and it's 10-minute email. And this is genius. And I understand it's been around for a while, or a version of this has been around for a while, but I just hadn't stumbled across it. So thank you, producer Dan, for bringing this to our attention. But it's a temporary inbox. The amount of times you are asked to sign up for things just to see something, whether it's the completion of an article or to get a resource or just to see what the service does. And then you find out, oh, that was a waste of time and now they've got my email. I'm sure you can relate to that experience. Well, 10-minute email can remove that experience. You can go to 10minutemail.net or just Google 10-minute mail and then you'll find different variations of it where you'll get a temporary email address, a temporary inbox, and you will be able to see what is sent to you. And then if you want to pass on your real email, you can do. But this is a great way of policing your inbox to make sure more rubbish doesn't arrive. It's a great idea. I'll definitely be taking advantage of it in the future. So thank you, Producer Dan. Great Hub Extra this week. Check it out.
Yeah, so if you're really not sure about signing up for our newsletter, Property Pulse, what you need to do is go to that website at 5:51 on a Friday morning, sign up for that. That'll get you Property Pulse. Your inbox will self-destruct 10 minutes later, and you can validate for yourself whether it's worth signing up for. Or in this case, you could just subscribe and unsubscribe politely if you don't like it. Either works, but that is a really great service. Signing in for Wi-Fi networks, that's where I always use things like that. Anyway, that is us done for this week. Thank you for joining us. I hope you enjoyed. And just before we finish, a very quick shout out to listener Tim, who's just reserved his 10th property through Property Hub Invest. Wow, that is absolutely amazing. And it's amazing for us as an endorsement of our service, but anyone hitting double figures in portfolio size, whatever the source, is worth celebrating. So well done to you, Tim. What a milestone. We will be back here next week for another great episode. Until then, have a great week. Bye-bye.
Bye-bye.